Phil, did you catch any of the Masters yesterday, that final round?
You know what? I'm not big into golf, but I did. I went over to visit my mother and father-in-law, and he is an avid golf fan, so I got to see the end of it. So it looked like it was that was huge. That was the first time in 25 years that someone had accomplished that. So that was a big deal.
A career Grand Slam.
He seems like a good guy.
Very very popular apparently. I told Bill, we were talking before we went on, and then my wife yesterday, because we kind of all were enthralled by this final round, even though most of my family isn't golf watchers. Both my sons were there, and my youngest son's wife and their dog. They all came over for dinner yesterday and had that on, and it was just compelling. It was hard to not watch it, if you know what I mean. And I was shocked that there have only been 6 Grand Slam winners. That's if you win all 4 of the major tournaments, Masters, U.S. Open, PGA Championship, and the British Open. There's only been 6 in the history of golf, and there's only been 2 in the last almost 60 years. It's a very rare feat, more rare than winning the Triple Crown in horse racing, which is winning all 3 races in one season.
And going back to not being a golf watcher, Bonnie and I fall in that category, but we were captured yesterday. We were just so thoroughly enjoying it.
I always try to watch the Masters because the golf course is just so beautiful, and I'd love to go there and catch a round at some point.
Back in my consulting days, I was consulting for the Easy Go Golf Cart Company, and their manufacturing facility is in Augusta. And it was within a couple of weeks, one way or the other, of the Masters. So I flew into Augusta, and the entire town is nothing but flowers. That is one gorgeous area to be.
My neighbor caught a round at Augusta for a women's tournament. I'm not sure which one it was a couple of years back. He said it was just whatever you see on TV, it's just that much better in person. And he also said you can't bring your cell phone onto the course. You've got to leave that in your car. Right? And then he was telling me how long they shut that course down even to their own members to get it in just the perfect shape for the tournament. But that tournament, that final round yesterday, I didn't watch much, if any, Thursday and Friday, but I watched a good bit on Saturday, and I watched almost the entire final round for McIlroy on Sunday. And I don't think I've ever seen anything like that before, with so many people in contention for the top spot at various points along that 5 hours of coverage yesterday.
And such raw emotion after he won. You don't see that normally with professionals. Going back to the cell phones, was that to keep a disturbance, the phone going off at the wrong time, or to keep someone from pirating pictures?
I did not ask.
Yeah, I don't either, but it could be for both.
I would assume it's a combination of both. Dylan just put his ears on. Maybe he knows an answer there. Dill, what do you got for me?
Not so much that, but I didn't actually, not being a huge golf fan, but or much of a golf fan at all, but being aware of some golfers and whatnot, didn't realize Rory McIlroy had never won the Masters. That was surprising to me, and didn't realize that he was kind of a career choke artist, considered that by many people. So that was a fun final round. I kind of was able to tune in after watching an overtime regular season finale game between the Clippers and the Warriors in the NBA, which was a great game too.
Yeah, there are 4 or 5 that makes up this this collection. I've forgotten what it's called, the Grand Champion of all of them. And McIlroy had won the other 4 very early in his career.
The other 3.
The other 3 then, early in his career. And so the only one remaining was the Masters, and he had played in the Masters, 17, 18 times?
17 times. Yeah. And he had a 5-stroke lead at one point. It looked like he was going to walk away with it, and it got a combination of a little bit of difficulty he had, and it wasn't a lot, but also some great golf being played behind him. And Rose surged out of nowhere, had an eagle. I think he birdied at 1.5 of 7 holes. He was charging pretty strongly. And then the sudden death hole. Rose was in the last time the Masters went to a sudden death. Rose was in it in 2017, and he lost to Sergio Garcia. And then to lose again 8 years later had to be heartbreaking for him. But the crowd seemed to want McIlroy to win that one and get the Grand Slam, and he did it. And it was
the level of concentration that these guys have to do what they do.
Oh, yeah.
I scored tickets to the PGA Seniors Tour quite a while ago, probably 10, 15 years ago, and I ended up following Jack Nicklaus. And first of all, he's got skin like a football. He's been out in the sun quite a lot.
A lot of golf.
But the intensity of his stare when he's going from one hole to the next, he's not seeing anything but what's in his head. People yelling at him and all that, and there's just such an intensity to his eyes that it's almost scary.
Well, the problem with people who are great at things is they make it look so easy.
Yeah.
And it's just not. No matter what it is, it's just not to excel at any individual particular thing, whether it's sports or whatever. Nicholas made golf look easy. These guys that are on TV yesterday make it look easy. It's not easy.
How many times you been to the Masters, Rob?
Been to it? I've never been to the Masters.
John, how many times you been to the Masters?
Not at all.
Bill, how many times you been to the Masters? Not at all. Joe Ferretti, our good friend Ferretti, said he's been there many times.
He lives there.
He lives, but many times he's been there. Thanks, Joe, for reminding us.
Yeah, Joe's our master. Steve Catlett's been there a couple times too. Yeah. Phil, let's talk some money here.
Let's do it.
Because this is some weird stuff going on here. We closed strongly I guess Friday, the last trading date of the week. We closed quite nicely, and we're opening up with some momentum this morning, despite the fact that we have the tariff doublespeak that's going on. The markets like the idea that there might be some exemptions for electronics and smartphones. The Trump administration quickly out with, well, we didn't actually say that, but the market hasn't corrected itself based on that correction. Or at least that statement, Phil. What's supplying the momentum this morning if it's not the exemptions to some computer tech and such for these tariffs?
I think it is at least a possibility of exemptions for some of those mega cap companies like Apple, who's up 6.5% in pre-market trading, finished the day on Friday up 4%. So you're looking at a 10% swing for one of the three largest companies on the S&P 500. NVIDIA's up 3% in overnight trading, 3.3. Finished the day up Friday of over 3% as well. And just going back to last week, after Wednesday, and then I'm speaking only of S&P right now, 9.5%. Last Wednesday, we had two winning days last week, but still the best week the S&P had since November of 2023, so well over a year. The best week ever. It didn't feel that way to many people because of all the volatility and because of what happened the week before. But Wednesday and Friday saved us, and we had up over 5%, I think it was, for the week for the S&P, and then that momentum continues on. And I think there's a combination thing. One, you hear, like you said, double speak or whatever it is that Lutnick had said. There's going to be some exemptions, and then there was a tweet and I don't know if it was a tweet, but on social media post that there would be no exemption, but that momentum continued to carry through. So at least the hope of some exemptions, and maybe we're getting a little bit desensitized to the tariffs with the tariff talk, and we're just focused on that 90-day reprieve from everyone except for China. But man, it's a lot. It is a lot to keep up with. And we can't forget, and it didn't have the impact that I thought it would, or maybe it just kept us from falling more, but we had some inflation reports that came out that were a little bit better than what was expected. And I expected to see some green numbers on that day, but we didn't. We saw a negative day, and then the next day it was positive when we started talking about it. But there's so much news coming on right now, so much volatility, and I think the least volatile day we had was still an epic volatile day. The movement of the markets within a 10-minute period. I think it was on Tuesday. I think that was the day. Don't hold me to that. That was the most that we had ever seen, but that day was negative 1.57. It's just crazy movements right now, and a solid reminder to us all to try not to time this because it could be so dangerous. If you would have sold out, say, on Tuesday, and there was really nothing on Tuesday that would have said, hey, there's greener pastures ahead, and then that day that we had on Wednesday, and then Thursday was negative, so some thinking, oh, here we go again, and maybe it's time to go now, and then we had that great day on Friday, and then what looks to be, of course, we've seen this happen more than not, but that the day is going to start off really well, but we don't know how that's going to turn out, but there's just so much coming at us, and it's hard to decipher between what matters and what doesn't. and there's investors that's focused on different things. And there's algorithms that's getting triggered on these volatile days that really have nothing to do with nothing other than algorithms. And it's mutual funds that are forced to buy or sell. But there's just a lot coming at us right now, and we're in the middle of a tornado, if you will. And it's not the time to get up and seek shelter somewhere else, because you could get blown away.
Phil, in 2020, the bond market started crashing, and the Fed bought back something like $1.6 trillion worth of bonds. With the bond crash last Tuesday, was there any talk at all of the Fed buying back bonds at that time?
There wasn't, and a lot of giving credit to some of that 90-day reprieve that we had gotten. A lot of people would say, what's Trump focused on the most? What would be his breaking point to where he would back off, or administration as a whole would back off on some of these tariffs? And we didn't know, because the week prior, everyone thought maybe it's the stock market, but apparently not. And then that bond market crashed, and that kind of spooked him, or spooked the administration, and maybe someone got in his ear, and he did the 90-day reprieve, and boom, that great day that we had. But there are two parts of this story. One is the equity market, and the other is the bond market that we talk about so very little. There's not much speak coming out of the bond market. But as far as the Federal Reserve is concerned, no, there wasn't. Not that I heard anyway, that there wasn't anything coming from the Federal Reserve, and they're kind of taking a stance right now where we're looking at the economic indicators no different than what we have been doing in the past few years, because how can we decipher or know, number one, what are these tariffs going to be, and number two, what are they going to do? We're going to allow these indicators, the employment market as well as the inflation readings, tell us what we should do.
I knew they were taking that position with equities, but with bonds, can drive the market much lower, much faster than what the equities can. So.
Especially on the mega cap side, because those are the ones that are impacted most by the movement of bond yields. And a long, boring discussion of why that is, but most of them don't pay dividends, and that's why that is. But the bond yields, for the longest period, we were saying, hey, look, your bond portion of your portfolio, and it's still for the year, it's still not bad. But make no mistake, if you look at a year snapshot, bond performance has been okay. But we did get a spook last Tuesday, and then, of course, we turned tail a little bit on Wednesday.
Mr. Gilstrap.
Yeah, I was going to send you a message, I think, on Tuesday or Wednesday when the big bounce happened, because we spoke. I think I kind of put you into a corner saying, isn't this the time when the Dow was dancing around in the 37s? Isn't this the time for, if somebody needs to pay for the education, that they should convert to cash and ride out the storm? And then a couple of days later, it bounced back. I think you get a victory lap, I think, for hanging on and just weathering the storm.
Yeah, and it's not a popular response, because people are coming, and we don't, and make no mistake, we don't have a lot of clients that call in overly concerned. We have more. It makes us busy. People calling in that's sitting on cash. Their emergency funds have gotten too fat, if you will, and they're saying, hey, now's a good time for us to throw this into the equity side of our portfolio. But we also have to be very disciplined, because we see depressed equity prices and think to ourselves, boy, it's a good time to buy into that. It's cheap now. But we don't want to change our clients' overall asset allocation. So if they're 60% equities when the markets are at an all-time high and everything looks great, we want them to be a 60% equity when the markets are low and everything looks bleak as well. So that asset allocation discipline that we try to enforce on our clients, we have to have it too. But we have a lot of clients calling with cash. And, if it ventures up to, say, a 63% allocation, that's acceptable. That's okay. You still are who you are at that level. But it is very important to stay disciplined and, to use maybe a silly analogy that Mrs. McCoy likes to tease me about using analogies. But we're in the middle of a tornado, and you don't get up in the midst of that, and seek shelter somewhere else, because you could get blown away. That's the best way I can think of it. Hold on tight to where you are. And once that tornado passes, you say, look, was this the right place to be? and this tornado will pass. And I think Wednesday was a good example of that. Even Monday, which was a terrible day, we got a really good example of how quickly this can change, because this is man-made, and it could be fixed by man, or it could be fixed by words. But Monday, which turned out to be a terrible day, but at one point in a 12-minute time span where S&P moved 10%, it was negative 3%. There was talk of a 90-day pause, which come to pass on Wednesday, by the way, and then it was debunked about 10 minutes later. So we went from negative 3.5 to positive 3.5, back down to negative 3 in the course of 15 minutes. And if you were just got up to make your breakfast or coffee, you would have missed that entire move. But it was all based off of words. So, and that is what's swaying our markets right now. So these aren't economic reports that we're waiting for on weeks on end, or employment reports. These are the news cycle is running our markets right now. So it is very windy out there. So hang on where you are.
Here's what's coming up this week, Phil. So today, the Fed Reserve officials Bostic and Barkin speak. Tomorrow, the release of the Export and Import Price Index. Wednesday, economic reports like retail sales, industrial production, and business inventories. And then Thursday, jobless claims and building permits. So there's a lot of stuff to decipher this week. Which of those do you think are the more important ones to pay attention to?
I think this week it's going to be the jobless reports, and maybe one that you didn't mention is earnings from big banks and what their perception of what our economy looks like right now in the forward-looking guidance that they're to give as it pertains to current or interest rates, future interest rates. So all of those are going to mean something, but the economic indicators, because now we're looking for almost a begin point from the trade war and what it's going to look like. Those economic reports of where we are right now in a snapshot is very, very important, because that could lead us to how strong of a position are we in? How long of this can we take compared to especially China, in opposition to China? Because we're inflicting – tariffs will increase prices, right? We know that. So even to me, and I have a very close client who's one of the smartest clients that we have that disagrees with me, but we'll continue to agree to disagree. Tariffs are a consumption tax. At the end of the day, they are a consumption tax. So how much can the American consumer stand of the consumption tax opposed to the maybe overseas consumers? Can they stand a consumption tax on the reciprocal tariffs, and who is likely to break first, and what will it all mean? But it is moving everywhere, and you've got a lot of people that have different opinions on whether tariffs should exist and if it's good for the economy or bad for the economy. What most people do agree on, though, that the force that they were brought with just a couple weeks ago was a little bit strong, and our markets reacted as such. And I think that's why we got that rally on Wednesday with the 90-day reprieve. But the base tariffs would remain, and our markets took off with that. I think our markets are saying, hey, a base tariff would be fine, but some of the 64 and the 82% here, and they're all over the place. Our markets didn't like that. It was hard to absorb, and it was hard to determine what does that mean for overall prices.
Phil, let's go back to bonds very quickly. As we know, China is one of the major holders of U.S. debt in the form of bonds, second only to Japan. But a couple of months ago, China started unloading some of their debt, which has been purchased by the Fed. On the surface, this is a good sign. Is there any reason to think this is anything other than a good indicator, with China getting rid of some of the U.S. debt and being purchased by the Feds?
The bad side to it is, and this goes back to the secondary market prices of bonds, and from that standpoint, in some cases, it does look like the stock market. So when you look at the Dow, S&P, and NASDAQ, you want it to see green, correct? So for the current holdings I have, I want that to be green. That means my current equity positions are doing well. It's the flip side on bonds. So when you look at bonds, you're looking at short-term, mid-term, long-term bonds. You want to see that be red, and that's very confusing to a lot of people. You want the current bond yields to go down. That means the current price of the existing bonds will go up, right? So bond yields go down, the current prices go up. If the current prices go down, bond yields go up. if they sell too much bonds at one time, that floods the market with secondary bonds, and that can make the prices go down. So that would make your current portfolio go down. So if they do too much, and especially if there's no buyer for them, or if our Fed doesn't pick them up or someone doesn't pick them up, then that's going to flood the market with sales, just like the stock market, and then in which case it would make the current price of bonds go down. What we would see on our ticker is bond yields go up, and a lot of people see that and think, yay, bond yields are going up. That means the price of existing bonds are going down, and that could happen if they unload too much too fast. That's actually a fear that we have, that as part of this trade war, that China would drop too much of our bonds all at one time. That could have an adverse impact on our overall bond market. And more importantly to us anyway, are those portfolios, the retirees, the conservative retirees portfolios would be damaged by that.
You always want to see interest rates go down, not up.
But doesn't
Well, yes, you, unless you're holding a bunch of cash, you do want to see interest rates go down.
Yeah.
But if I know you don't like to talk politics, but this gets to if we assume that China is our next enemy, as they've sort of pronounced themselves to be, the fact that they hold our economic future in their hands means that this thing has spun out of control and needs to somehow be brought back in. You know, they control our supply chain and they control our money supply. And what's interesting and kind of terrifying through all of this is that trying to find a way to fix this without tanking the stock market and ruining everybody's 401ks is proving to be quite the challenge.
It's a tightrope, and how hard can we push versus how hard can they push? We're both relying on each other. So, which goes back to why these current economic positions that we're in. What's inflation look like? What's our employment look like? Consumer sentiment hit a low last week, which kind of told us that there would be a bounce in the stock market. That's a weird gauge. But when consumer confidence drops, the next thing that happens, the stock market takes off, which is kind of strange. But where is our consumer versus their consumer, and how hard can we push, and how much are we willing to take? That's why that's so important, because they do hold an ace in the hole because they hold so much of our debt.
Well,
but yet our Japan holds more of a debt than what China does. Do we view Japan as the same hammer over our leverage as what we do China?
No, because we don't buy as much as we do from Japan as we do from China. China brings so much of their exports come directly here. We're their number one customer. So, and you'd be hard-pressed to find anything that doesn't say made in China on it to some level. So we buy more from China than what we do Japan, and I think Japan buys more from us than what we buy from them. I could be wrong on that, but that trade imbalance isn't as bad with Japan anyway than it is with China.
How do we reach you for more information today, Philip?
You can reach us at 304-263-4343 or stop by and see us with an appointment at 1270 Winchester Avenue right here in Martinsburg.
Thank you, Phil. Have a great day.
Thank you, guys.
Thanks, Phil.
Catch Financial Phil each weekday morning at 6:38 for 2 minutes on the market that day, replayed at 7:38